as Wall Street awaits the much-anticipated big tech reports that make up nearly $5 trillion in market capital. Well, for more, let's bring in founder and chief market strategist of thetechnicaltraders.com, Chris Vermeulen, and CEO of Pento Portfolio Strategies, Michael Pento. Gentlemen, thank you for joining me today.
Thanks for having me.
Michael, let's start with you. The Federal Reserve made no changes this week after its meetings, of 2 days of meetings. Fed Chairman Powell also even argued that the pandemic is pushing down prices and that overall inflation is actually running well below the Fed's 2% target. We are seeing some prices driven up in food prices. Is the U.S. at risk for hyperinflation?
Well, first of all, I hate to disagree with you being, coming a guest on your show, but first of all, the Fed, I thought, made two changes to their statement. Number one is they added a thinking about to their statement. So it used to be the Fed wasn't thinking about raising rates. Now they're not thinking about raising interest rates. That was change number one. And the other change is the first time I ever heard Mr. Powell avow that the Fed's target is symmetrical. Its 2% target is symmetrical, meaning that for as many years that it was below 2% on the core PCE deflator, it has to now be above 2% on this particular metric that measures everything except what is rising in the economy. So since the core PCE deflator has been below 2% for pretty much the last 20 years, with rare exceptions, I think Mr. Powell, or whoever's running the Fed, now wants inflation to run above 2% for 20 years. So God help us all.
Well, I want to do that. They're going to keep the rates at least where they are, he said, until the economy can actually recover on its own. That's when essentially we practically have a vaccine. But Chris, tonight it's a pivotal moment that we're looking for here in the market with four of the big tech companies reporting earnings. Much like Christy said, they've been holding the market up the last couple of months. These guys basically led the rally. What should we expect to see?
Yeah, well, I think we're going to see a lot of big movement going after tonight's earnings. And it's going to be interesting because they've obviously led the way. They're the heavyweights. I mean, you look at the NASDAQ, they really carry $5 trillion. They're 35% of the NASDAQ value. They're roughly about 17% of the SP 500. So when they move the market. And of course, these big guys have been driving the markets higher. And, we've seen a huge rally going into earnings. The big question is what's going to happen tomorrow? Because typically we see kind of buy the rumor, sell the news. So they've had a huge run up. You look at Amazon, up 100% just since the March lows. And we might see some profit taking. And that's what we've seen in the past with companies when they come out with good earnings that we're all expecting. And so you sell into that news. So we might see some type of pullback just around the corner here.
Now, Michael, let's go back to the Fed, right? Their next move is possibly to yield the curve control. Explain that a little bit. We saw this in Japan. They were the first to actually try this, and they're keeping their rates around zero. And so far, they say it's been working.
So, yeah, it's working great in Japan, too. You see their banking system is crumbling in Europe. So yield curve control, yield curve suppression means that you want to take long-term rates to equal short-term rates. And so they're both going to be zero. I mean, that is not a recipe for a healthy banking system. I just want to turn to what Chris was talking about before. Also, if you take Apple, Microsoft, and Amazon, those three tech stocks are now equal to 25% of U.S. GDP, which is plunging at a 32.9% annualized rate. So this is the most narrow and most expensive stock market in history. You better know where to invest and how to get out of your investments when the time is right.
Well, Chris, we've talked about this whole pandemic trade before, right? Names that have benefited from the coronavirus, such as healthcare names, consumer staples, and even a lot of telecommunication names. But as the rally started, we saw that rotation out of these names and into higher beta tech names, right? It seems like the pandemic trade isn't over. Comcast and UPS reported these huge surges. What's going on there? And is it still too early to rotate out?
Yeah, it's tough to say. There's a lot of mixed signals, whether it's the technicals, the market breadth, fewer stocks holding the market up, the economy just in general. There's a lot of mixed signals out there. But what we're going through with this pandemic is it's a change. It's like we kind of thought we were a tech world already, but now the corona hit, really it's forcing a new wave of how we live life, how we work. People aren't going to be doing the rat race, running, commuting to work every day. They're forced to stay at home. They prefer staying home. And so now we're seeing everyone spend money on technology. They're turning bedrooms into offices. Services are being used. So we're having this world change in how we do things. And of course, there's going to be big companies benefiting, shipping companies, obviously UPS, Amazon's kind of like the grocery store and the shopping mall of the world. So there's a big change, and I think it could carry on quite a bit longer as this market tries to really adjust to this new way of life.
Well, new way of life, definitely. We're seeing this volatility in the markets, originally with the V-shaped recovery, then a possible U-shape, and now we don't know what we're seeing. Even President Trump is saying a really bad day for the markets. Still waiting on that tech earnings report, though. But Michael, let me ask you this. The dollar remains on course for the worst performance in decades. What's the risk if we continue on course with this ultra-loose monetary policy for years to come?
It's a very big risk. Let me tell you why. Because the Fed is now forced to permanently monetize our debt. Our national debt is now 130% of GDP. We're looking more and more like Greece as time goes by. And I'll tell you this, it's even worse. You're adding to that debt load $4 trillion in fiscal 2020. So you're looking at a debt that's 20 deficits, 20 to 25% of GDP. By the way, that debt is now 1,000% of our revenue. We are permanently forced to monetize this debt. The Fed is not going to be able to extricate itself from this problem, just like it wasn't able to extricate itself out of the Great Recession. I'll remind all your audience that in 2019, before anyone ever heard of a Wuhan virus, the Fed was cutting rates 3 times.
Right.
So we're trapped in this endless cycle of yield repression for a very, very long time and debt monetization, unfortunately.
Well, cutting rates, so far there's no change to that as far as if they would go negative. I know many are pushing for that, but we'll have to wait and see until their next meeting in September. Chris Vermeulen, founder and chief market strategist of thetechnicaltraders.com, and Michael Pento, president and founder of Pento Portfolio Strategies. Thank you so much for making time for us today.
Thank you.